Hi, good evening, everybody. Hello. Uh, okay, I think we can start as we wait for more people to come in. So how's everyone doing? Good evening. Amazing. Yeah, same. Just end the work as well. Uh, Third lecture already, so we are somewhere in between the module. For those who did not see or check your email, just want to let all you all know that the TMA results are out. So at the end of the lecture, we will have some time and then we can go through any queries or any concerns you have for the TMA. At the same time as well, with some key main learning points as well. We will go through them at the end of the lecture. Okay, so in case you have not noticed, you can go on the our Blackboard to check your grades. I think overall the class did well. I think average is around almost 75. So yeah, in case you did not do too well, do not worry. You still have your group project as well as your ECA, and both of it has a very high percentage as well. So you can work hard on those. Okay. Let's start 7:04. Let's kickstart today's lecture. All right, so today's lecture is on the first valuation model that we have covered, that we'll be covering. So recall lecture one, we were focusing mostly on the qualitative component of equity valuation, right? We talk about various tools. And then for lecture two, it was more of an overview of the various quantitative models that we'll be using and trying to understand, right? And so today, what we're doing is a deep dive into the first model, arguably the simplest, which is the dividend discount model. And we'll go through some details in terms of not your standard kind of dividend discount model you have covered in other lectures or other modules, where it's kind of simple. So we'll try to do a bit more advanced level kind of dividend discount model. And I want to highlight that it's quite important because our subsequent models will use similar frameworks. Subsequent model meaning whether it's your free cash flow to firm, free cash flow to equity, will use similar frameworks to analyze those models as well. So this lecture is very important as a foundation to the first quantitative framework. Although I think most of the time for your GBA or even your ECA, chances are you're unlikely to use the dividend discount model, but you do need to know this concept, right? Okay, so let's kickstart what we are covering today. Just pull up my pen. Okay, so when we think about dividend, right? We need to understand that there are three key or three key stages in terms of how dividends will be declared based on the growth of the firm, right? So when the firm just start up, right, like a new startup, generally there's very high growth for the firm. And this is when the firm is, still in its infancy, is still trying to mature over time. Um, and because of that, generally we expect, high investment needs, and these can include things like capex. All right, things like capex. At the same time, because a lot of investment is required, we will need to, or not we will need to, but the company will not be able to actually pay much dividends. So dividends are actually typically low or almost to zero. As well as in a startup, generally it's considered very high risk kind of company. Of course, with a very high growth prospect as well. Right. So this is the first stage of dividend. Um, and then we have the normal growth stage where the company is kind of stable, it's still growing, but it's stable. There is, of course, more maybe competition, maybe there's some barriers to entry. The growth rate will have decreased to kind of a normal growth rate, or we call it GL. You'll see this in a bit. We call it GL, normal growth rate, that can be sustained for a long time. Generally, companies in this stage, investment needs are generally lesser, so less capex. Yes, you do need a bit of capex, but not too much. Amount of dividend paid higher compared to your high growth stage. All right. Last but not least, the no growth stage. So no growth stage, what happens is that your revenue, there's no further growth in your revenue, meaning that there's no need for more investment. It's kind of a stagnant stage really. Very unlikely you'll see this in real life because companies always want to grow, right? However, in a theoretical case where there's no growth, company will pay all the earnings as dividends. I'm going to put 2 stars here. So this is a characteristics that you need to know whenever a question or whenever somebody say there's no growth. You'll see this in an example in a bit, but whenever that you see no growth, it means that all the earnings is equal to dividends. So 100% is in dividends. So I have a question here, right? Why, when you pay 100% in dividends, there is no growth? So the question is, why when we pay 100% of our earnings in dividends, there'll be no growth? Anyone knows? No money to reinvest, no reinvestment. Okay, that's correct. Are we able to have a formula to say, prove to us this, right? Yes, you're right. No retained earnings. So those are more qualitative, right? Quantitatively speaking, are we able to prove that when there's 100%, there's no growth, and you pay 100% dividends, there is no growth? You are right. Perfect. Thanks. So G equals to ROE times 1 minus dividend payout, right? So if your dividend payout ratio is 1, right? 1 minus 1 is 0. And so ROE times 0. So ROE times 0 equals to 0. So G becomes 0. Yeah, right. So that's the formula that proves to us that when there's no growth, when you pay everything out as dividend, there'll be no growth. So again, I would like to highlight again, this is the important characteristics that you need to know when a question posed to you say there is no growth. Okay. Next, the risk level reduced to a normal level, and there's no growth in this stage. Okay. All right. So this is a summary on what we discussed earlier. Not going to cover this. And then this is the dividend growth stage. So like to just kind of highlight again at the start, there's the growth period where dividend payout is quite low, but this is a high growth stage. And then maybe you have some more maturity level, which is the middle. And then finally there is more of the no growth, right? It can either decline or maybe it just flats, just become flat and become no growth. Okay, so we understand that having understood the various stages of dividend growth, let's try to put this in a quantitative model, right? So there are 3 key models that we want to try to understand for dividend growth. Okay, the first is the most simple is the single stage model. So single stage model means that, okay, there's only growth or no growth, right? Will not be growing or will be growing. So it's growth or no growth. And we want to plot the graph of growth, G on the y-axis, and T, which is time, on the x-axis, right? So in the case of not growing, means your G equals 0. So this is the case where G equals to 0, no growth. Maybe there's growth, but then it's a single stage, meaning that it is flat growth. So in this case, for example, G may be, let's say, 2%, right? Means that for the next, I don't know how many years, whatever number of years, or forever, actually not even number of years, but forever, it will be growing at 2%. The second type, okay, so we'll go into details of the actually the two types of model. The third one will not be covered in our syllabus, but we'll go into details in just a bit. So this is just an overview of the three types of models that we have. So the second type of model is the two-stage model, and the two-stage model comes in the form of a high growth area where usually we call it GS. What's S? S is supernatural, so supernatural growth, right? At the start, and then suddenly there will be a dip at, let's say, TL, right? And the dip to TL will give you a growth of GL, which is growth at low level. So there's GS and GL. So generally, these two is the terminology, GS and GL. However, this is a sudden drop, which immediately you will see that maybe it doesn't make too much sense, right? How can it suddenly drop so quickly over just 1 second, or like not even 1 day, just 1 second, it just drops. So this one a bit questionable, but it's called two-stage model because you have two levels of growth. For the two-stage model, we have another model which makes a bit more sense. It's called the H model. And the idea of the H model is that the growth would decline from a GS, growth supernatural, to a growth low, right? And there will be a linear decline over a period of time. Okay. And the final model, which is out of syllabus, is the three-stage model. So the three-stage model brings into context that you have, first of all, a growth rate at the middle stage, which is constant, and then you have some linear decline in the stage two. So, in this sense, it means that, can you see this is like a H model, and then it will decline further. Or it can be a flat growth and then a decline, which is a H model at the second part. So for this three-stage model, you just need to know that this kind of model exists, how you can actually understand it in a sense of there is first H model here and then a decline, or a flat growth and a H model here, right? But you do not really need to use this model in your valuation. Okay. And before we move on, again, it's like probably a broken record by now. You know that in this course we are covering various tools used for equity valuation, right? So, which model you choose, maybe you will ask me, oh, which one should I choose in, let's say, my GBA or ECA, right? The idea is that you need to choose one that you feel will best allow you to value the company, right? There is no right or wrong. Of course, if you choose a flat line, kind of like a single growth model, yeah, it could be correct as well. And in any case, will have to justify why you use a certain model. And that's more important than actually just randomly choosing a model and then using a model, right? So really try to justify why you think that is the best model to use to value your firm. So this is just a bit of details on the three-stage model, even though it's not in your syllabus. However, for those who are taking like the CFA, generally the CFA covers the three-stage model as well. But how you think about it is this, right? Like I mentioned, one part would be consisting of a H model, and the other part is either a flat, constant growth or a declining growth, as you can see here. Right, let me just highlight for you again. This is the H model, and there is a declining growth here, or flat closure. Okay, okay. So that's just an overview on the uh, three key models that we're covering. Now let's go into detail, right? How do you do the calculations? What formula should you use? Let's go into the detail stuff. Okay, so for the first model, let's think about the no growth model first. So there's no growth, meaning that your growth equals to zero. So growth equals to zero. When the company have no growth, like we mentioned earlier, dividend payout ratio is 100%, as you can prove to yourself. G equals to ROE times 1 minus dividend dividend payout ratio. DPR, dividend payout ratio. And if dividend payout ratio equals to 1, then everything is 0. So growth is 0. So all earnings are paid out as dividend. Again, I'm going to put two stars here to again highlight to you that this is a condition for no growth, meaning that if the question say no growth, you are expected to know that the dividend payout is 100%. No growth dividend means that the stream of cash flow, there's equal stream of cash flow each year, uh, forever. And one of the ways or the key way to calculate this model with no growth is basically just to use the present value of perpetuity, right? Because there's no growth, you're right. So yes, you're right. Perpetuity is 1, D1 divided by R. So recall lecture 1. Uh, so I did have a small little recap here, which is C divided by R or D1 divided by R. The very important take note is that your payment must start from one period from today, which means it's D1. What does this mean? It means that when you ever read a question, you got to be very careful what kind of dividend are they giving you. Because in order to use this formula, um, which is the present value of perpetuity, we need to have D1, dividend in one period from now. Let me see. I think there is a example. Okay, there is maybe the example is much later, but I want to explain to you why is this important, even though this is a perpetuity. Meaning perpetuity, what does it mean? It means that you get $100, $100. You just keep on getting $100, right? Then the question is, why why is having D1 important? Why is this important? Anyone want to give it a try? Because everything is $100, right? So why is it important? Why D0 and D1 is still $100, correct? No, but it's no growth, so not supposed to increase. Good try, good try. Okay, so let's try to think about this. This is a good one. Okay, let's draw a timeline. So whenever we solve this kind of question, this kind of meaning like this kind of cash flow question, I always like to do a timeline because it gives you more visualization. Okay, let's see. This in case it's one time discount one period more if it's D0. Okay, I can you are about right. Yeah, discount one period more, you're right. About that. Cost dividend is paid at end of the year. Yeah, it's paid at the end of the year. Hmm. I think the comment on discount one period more, it's about that. So let's try to understand. So we have a timeline here, right? Let's say the firm pays out dividend. Okay. Now, of course, the timing now is time equals to 0, right? Now is here, right? This is now. Okay, so let's just say the firm is going to only pay dividends, but at a no growth level, meaning 100, let's say it's 100 dividends, right? But only paid in year four onwards. So year four onwards is going to pay 100, 100, 100 non-stop for perpetuity. Okay, so why is this D1 important? Because we have to first, let's say I want to say, okay, now value this firm that has no growth but only pays dividend in year four. So how do you do this? Whenever you want to use this present value perpetuity formula, what you're doing first is you are using this formula in year three. So 100 divided by R, and this is in year three, right? Yeah, right. So when this is year three, so this is the present value. Let me just, I want to be a bit more accurate. I want to say present value in year three. Okay, so this 100 divided by R is in year three. So this is why it's important because the D1, which is this one, I'm just going to use a highlight. D1 here is in year four, right? And then to use this formula means that you are taking the point at year three. Now, after you have done this, then you have to discount it back 2 years, right? So once you have a value here, I always like to consider call this the bunny hop. So you want to hop back 1 year. So let me see. 1, 2, 3. Sorry, 3 years. One, so 1, 2, 3. So your this value 100 divided by R will have to be divided by 1 plus R to the power of 3. So you have to bring it back to the period now. Everyone understand about this point? You yes? Because this is very important because you know I always notice that for questions always like to try to trick you in a sense that okay, yeah, why is this one D1 important? It's because when you take D1, meaning that if the firm starts paying in year four, so I'm just going to repeat again, if the firm starts paying dividends only in year four, means that when you use this formula here, the formula takes into account the period at year three, right? So that means when you use this formula, because it's D1, so this is D1 here, right? So once you have this formula here, which is the value of the firm, but this is value of firm in year three, you have to, after that, discount it back 1 year, 2 year, 3 year. Do the bunny hop 3 times back to 1, 2, 3 to year zero, and therefore you get this thing here. Any questions? Anyone need me to repeat or not too sure? Yeah. Okay. So having done that, okay, so let's look at this concept of returns. So generally, in a stock, this is quite normal, right? When you buy a stock, there's dividend yield and there's capital gain yield, right? If the stock price increase, capital gain increase, then when you give dividend, you have some yield as well. Of course, when the company has no growth, means that you not grow, of course. Therefore, capital gain yield is zero. So all your returns comes from the dividend yield, which is this. So sometimes questions would like to ask you like, oh, okay, in the case of a no growth company, what is the capital gain yield? So this might when you see this slide, you might, huh? Why even I am going through this slide, right? But then sometimes in the question, you don't really think about things like, oh, okay, if there's no growth, everything's paid off dividends, means your capital there's no capital gains yield at all, right? So sometimes, yeah, questions are a bit, they want you to think a bit. So try to, kind of bring in this concept as well. A stock has capital gains, have dividend gains. If everything is being paid in a form of dividends, then there's no growth, means there's no capital gain. All right. So going on to the next one where we have a stable growth. So a stable growth means what? It means it is growing where there is a G. G equals to, let's say, 3%, right? It's growing at 3% um, year after year. So it's growing at a constant rate. Uh, Company is in a normal growth. Payout ratio remains constant, right? Constant payout ratio, constant growth, or constant G that you can calculate. The payout is less than 100. This makes sense now, right? If it's payout less than 100, means that there's some capital gains, right? Remember the last slide? The yield is based on capital gain or dividend gain. So, if not everything is paid out as dividend, means that there's some capital gain as well. Stable growth of dividend payout. This is where G kind of is constant at 3%. Let's just say this. Growing stream of cash flow that lasts forever. So in this sense, instead of just the present value of perpetuity, you have now the present value of your growing perpetuity. So it grow at, let's say in this case, 3% non-stop. All right. So if you recall lecture one, um, even though we didn't really go in detail, but the recap slide on time value of money actually gives us the growing perpetuity formula, and it's very similar to our normal perpetuity, just that we need to include our growth factor here. So again, it's D1 divided by R minus G, where R is the return on equity and G is the growth rate. There's a small comment here which is important, again to highlight that D naught is the dividend now, which is important. So when you read a question, if they say dividend now, it's D1, and sorry, D naught, and when it's D1 is dividend one period from today. So this is a small recap on lecture 2. So the sustainable growth rate, as you mentioned earlier, which is ROE minus times 1 minus retention ratio, the rate at which the company can grow using its own funds. So important thing is its own funds because it's sustainable growth rate. There are a few ways to estimate the growth rate. This one is your formula that we mentioned earlier. We can also use some historical data in the form of average growth of the firm in the last 5 years, 10 years. That's possible as well. Or sometimes we can use analyst forecasts using, market intelligence tools, such as your Refinitiv, which all of you should have, and really encourage you to use the Refinitiv platform for your GBA and ECA, because the information provided is much better than your Yahoo Finance. Okay, so use Refinitiv or use S&P Capital IQ, which are both platforms that are available to you at SUSS. So there are some assumptions where we think about the sustainable growth rate. Unfortunately, they can be quite limiting assumptions, but we still use them, right? So things like constant profit margin. Because if your profit margin keep on changing, which actually makes sense, most of the firm profit margin will keep on changing. But if you want a sustainable growth rate, you can only use this when profit margin is constant, your leverage is constant as well, and your dividend payout is very stable. These are very harsh assumptions, which is why sometimes when we use the sustainable growth rate formula, it might not make too much sense because profit margin changes, leverage changes, even payout policy might change over time as well, which is why many of the times we use either the analyst forecast, right, which can be found in the market intelligence tool, or we use like a historical average, which might be better than using the formula G equals to ROE times 1 minus payout. So a bit of theory behind sustainable growth rate. So if your company is growing faster than the optimal growth rate, this might not be too good, right? So the company is growing too fast. Means what? You either, first of all, you prune away some activities that you feel is not the core activities. Prune away meaning that by removing these activities, you reduce the growth of the company so that it will be lesser or equal to the optimal growth rate. Or you, in order to continuously meet your growth, you need to go to external financing. And why is this the case? Is because it means that the company is not able to grow with its own funds, which is the meaning of sustainable growth rate. Therefore, you have to use external financing to meet your growth, which is beyond or more than your sustainable growth rate. Okay. Maybe what you want to do is you want to do some outsourcing of your productions to lower costs, or you merge some cash cow businesses to lower the growth rate, right? So your cash cows are generally very high high growth. You kind of like you merge it to reduce your optimal growth rate. In a case where your growth is less than optimal, then you have to increase your growth, right? So in a case, you can purchase a company that is growing very fast. You do take over, of another company, maybe M&A, or you can distribute, some excess cash to your shareholders so that you increase the dividends. And therefore reduce your growth, right? So of course, at the end of the day, there's a small comment here. No company grow at constant rate. However, if we take a long period, we can try to find the average. So using the historical average generally is a good way to determine your growth for your equity valuation, to value your equity, right? So use the historical average. That's generally the better method to determine what's your growth rate in your valuation model. Just a short pause. Any questions so far? No? Okay. Just notice this lecture, I'm trying to go a bit slower because I know the last two lectures can be quite heavy in content. For this lecture, we do have a bit more time, so I'm trying to go a bit slower. And of course, it's also important concepts here. All right. So we do have a simple question. Let's look at this example. JCPenney stocks, the required rate of the JCPenney stocks is 8.8% using capex. On examination, you believe stable growth at 6%. For long-term prospect, it's currently paying a dividend of 0.5. So current dividend of 0.5, is this D naught or D1? D naught. You're right. This is D naught. Okay. So calculate the Gordon growth model for the value of the stock. Okay, so this one it's quite simple. We can just use the growing perpetuity formula. So growing perpetuity, since this is D naught, like what all of you mentioned, which is correct, you need to make it to D1. So you multiply by G, 1 plus G, which is 6%, as given here. Then we take R minus G, and then we get the solution here. So going back to part 2, let's just look at it. The current price of the stock is 25. So we know that the current price is 25. What you have valued is 18.93. It means that this stock is overvalued, right? The intrinsic value is only 18.93. And the thing is, the market is selling at 25, means that it's overvalued. So you should sell the stock. One more question, very similar. So in this case, this company pays a dividend of 4.25 next year. So next year, this is D0 or D1? D1, yeah, right. D1 now. That's correct. Okay, best estimate for dividend is to decline. So it's a decline, decline forever at 10%. The required rate of return is 12%. So since the decline, please remember put the negative here. And because it's a negative, you notice that because minus times minus go positive. So at the end of the day, the valuation of this stock is 19.32. Okay, so this is an interesting example. Let's look at this. So ACME Limited has earnings of 15 million. Okay, it has 5 million shares outstanding. So these are shares outstanding. It retained an amount of 6 million. Okay, retained. So this is the amount that's been retained out of the earnings, right? This is the earnings. So it's retaining 6 million. Its equity at the beginning of 2008 is 60 million. Okay, the earnings are expected to grow at a sustainable rate of for a long time. The risk-free rate is 4%, market risk premium. So this market risk premium, put a star here because it's a market risk premium. It's not the market returns. It's estimated at 7%. Beta is 1.1. So let's try to estimate the value of this share. Okay, so once we are given this, so this is important. So once we are given all these kind of like balance sheet number, I hope that this will trigger you to straight away try to think about this concept of using G equals to ROE times 1 minus payout ratio. So whenever you see a question that gives you this kind of balance sheet figure, immediately go to the idea that, okay, I need to calculate G using the sustainable growth rate formula. Because we have earnings, we have retained, earnings, we have retained earnings, we have payout. So once all these are in play, straight away think of this, right? So I put a star here that you need to think of this concept of sustainable growth rate. Okay, so let's try to use this thing. So we first calculate the earnings per share. So we know that we earn 15 million. We have 5 million of share. So earnings per share is 3. Retention ratio, because we know that, let's just see, what did we mention here? We mentioned that 6 million is being retained. So your retention ratio is 6 divided by 15. What is being retained means that 1 minus what is being retained is what is being paid out, which is your dividend payout ratio of 60%. And so if you so you pay out 60% of your earnings, right? Means that for on a per share basis, if you have 3 earnings per share times 60% gives you 1.8. So $1.8 will be paid out as dividends for each share. And then we know that ROE, return on equity, is how much do you return, which is 15 divided by total amount of equity, which is given the question. I'm just going to flip over, which is here, 60 million of equity. So return on equity is 25%. Now, there is a big typo here. This is actually wrong. So G equals to, so G should be what? G equals to what times what? Yeah, right? 0.25 times 0.4. Not 1 minus 40, is wait. It's yeah. It's not 1 minus 40. It's 40, right? Because your ROE is, yes. So ROE is sorry, sustainable growth rate is ROE times retention uh retention ratio or 1 minus payout ratio. Yeah. Okay, so unfortunately, this is a typo, so please take note of this. But this gives you 10%, still gives you 10%, which is fine. So once we calculate G, which is given here, this is the important part because you see how many steps you have to take in order to calculate G. So please take note that whenever you see a question giving you so many details on balance sheet numbers, um, try to think of the formula for sustainable growth rate. Okay, so once we calculate G, then that's the easy part already. We use the CAPM model to calculate cost of equity, since we are given the beta, and then we can simply calculate the value of the firm using growing perpetuity. Taking note that the dividends that is being given to you of 1.8, this is your D naught. So you need to multiply it by 1 plus G. Okay. Now, this is interesting. What is the value of growth? So this is an interesting part of the question. So usually you notice, exams they like to first part is the easy part, second part is the part that generally you'll see whether you really understand the concept, right? So part B is asking what's the value of growth? In order to find the value of growth, means that in a situation where there's no growth, how can we value this stock of no growth? Right? So you notice this is a very indirect way of testing you the concept of no growth. So when they ask you what's the value of growth, since that in part A we calculate the firm with a growth, then now let's assume there's no growth, we take a perpetuity, right? And question, how do we get 3 here? Why is it 3? Yeah, correct. Earnings per share. Because when there's no growth, 100% of your earnings is being paid, right? So again, can you see the concept? Yes, all is being paid out. So it goes back to the characteristic of no growth, right? This is the question that I want to highlight to you. Why is it important to know the concept that when there's no growth, you pay everything, all your earnings out as dividends? Yeah, totally right. So you see, no growth, therefore, this is 3 as dividends. You calculate what is the value of a no growth situation, and therefore by taking the growth minus no growth, you get the value of the growth factor. So this is a very indirect way of testing you the calculation for no growth. All right. So now the next step is, or the next model is our 2 stage. So we have done 1 stage. The 1 stage we have covered, the no growth and the stable growth. And now we do the 2 stage model. So in the 2 stage model, how do we do it? So imagine that your dividends is growing at 20% for 3 years. Okay, 20%. So this is your GS, growth supernatural, for 3 years. And it suddenly fall to 8% at growth normal or GL, growth low at 8%. Dividends D naught is 1.8. The cost of equity is 11.7. So this question, typically examiners will test you this because it requires quite a bit of calculation and understanding of how to use the formula. So let's try to dissect this. Okay, so we have 4 years, right? We drew a timeline of 4 years. Year 0, 1, 2, 3, 4. And we know that for each year, with our dividends for the first 3 years, our dividends will be growing at 20%. So let's just focus on this part here first. Our first year, our dividends grow at 20%. Now, second year, 20% times 2, not times 2, sorry, to the power of 2. And year 3 is to a power of 3. right? So for first 3 years, it's going to grow at the extra supernatural growth of 20%. Then in year 4, it's going to jump immediately to 8% growth. So step 1, calculate the dividends for first 3 years. Step 2, calculate the value of the dividends for year 4, right? Year 4. And now let's plug in the values in the timeline. And like I mentioned, the timeline is usually the best way to be able to see the figures, right? So let's plug in the figures here like this. So the first year, 2.16, second year, 2.529, third year, 3.11, and the last year is, not last year, sorry, the fourth year is 3.359. Okay, so we know that for the first 3 years, quite simple. We simply just have to discount the first 3 years dividend back to year 0 because this is now, right? This is a now. So this is now. So we discount them back, which is given by this part here, present value your dividends. Okay. After that, we now need to calculate the. Okay, let me see. So a question, why is it year 4 to power to 3? Okay, so why power to 3? Because I'm still using this, right? I'm still using the base 1.80 times 1.2 to the power of 3. Right? So if you use this figure, if you use 3.11, you just multiply it by 1.08. Does that make sense? Okay, I see another question. How do you get how do you get the perpetuity growth? Are you talking about step 4? Are you referring to step 4? Yeah, okay. So can you see here, after year three, right, the firm is just going to grow at uh 8% forever. So if it's growing 8% forever, this is your growing perpetuity. Okay. So we know that at year 4 it'll grow forever, right? At 3%. So this is the first dividend that is going to grow at 8%, sorry, at 8%. The first one that is growing 8% here. And then it goes on forever, non-stop, right? So recall that for your growing perpetuity formula, we always take the dividend 1 period from now, right? Which is why the example which I kind of explained to you earlier. So it means that if I want to determine the terminal value, TV, terminal value, using the growing perpetuity formula, uh, using the growing perpetuity formula, I can calculate it using this formula here, right? The growing perpetuity, which is the dividend in year 4 divided by the return on equity minus the growth factor of 0.08 or 8%. But this gives you the terminal value in year 3, right? This is step 4. So in step 5, I will have to discount this back 1, 2, 3, right? I need to do the bunny hop 3 times back to year 0, which is why we take the terminal value divided by 1 plus r to the power of 3. I'll pause here. Any questions regarding this? This is very important because in even your next lecture, when we talk about your FCFF, FCFE, we're going to use this same concept, right? We need to determine the terminal value. Then we need to discount the terminal value back by the number of years to year 0. So any questions on step 4 to step 5? Okay, need time to digest. Yeah, that if you have any questions, you can always ask me or can email me if you need to if you do have any queries. But let me just repeat again, because this is an important step. Okay, let me just erase some of these lines here so it's a bit easier to see. Okay, let's just erase this. So let me repeat again. So we know that in year four, okay, I'm just going to erase this as well. Okay, so we know that in year four here, the firm is going to grow at 8% forever, right? Which is why we determine the dividend in year four, which is here, given by this, the dividend in year four, okay? And then forever it just goes on, right? So since it's grown forever, it's a perpetuity, right? And it is growing at 8% rate, which means it's a growing perpetuity. So we can use the growing perpetuity to determine the terminal value or TV in short. And this value, terminal value we are determining is as of year three, right? Because like what I mentioned, is one period from now, right? So this formula here is as of year three here. But this is not done yet because we need to determine the terminal value as of year zero, which is the present value, which is the current time. So we need to hop back one, two, three. So you hop back three times. That's why we had to discount this three by the power of three. So this is the step 4 and step 5. So now we have determined the present value. So we have now determined the present value of the terminal value. After doing this, what do we need to do? We simply add up. Okay, what do we simply add up? We add up this, 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 and this. Four values given in step 6. Step 6 here. Yeah. So that's a good question. How does dividend smoothing affect the dividend discount in terms of the assumption that the firm will grow the dividend by the rate of ROE? So how does okay? So I'm thinking what you're trying to say is, how does dividend smoothing really affect your dividend discount model, right? And so the idea is that the dividend smoothing means that you want to distribute, whether is it a constant dividends, meaning a constant growth of the dividends, mean like 2% every year, keep on growing 2%, rather than some year 2%, some year you drop to 1%, go back to 3%, go back 2%, then go back to 1% again. So if you keep on changing, then of course it's not smooth, right? Your dividend payout is not smooth. So your dividend smoothing kind of help you um, use the assumption of, let's say, the growing perpetuity to value your terminal value and therefore value your firm. Okay. Any questions here? I'm just going to pause here for a quick moment. Any questions on this? Because this is our baseline how we do the simple, two-step model. So, um, so can we ignore the retention ratio if the firm practice smoothing of dividend and commit to set growth rate? Okay, so if the company, right, let's say you are valuing a company and they have already set a growth rate of, let's say, they say they're going to grow at 5%, right? And it's set. And probably chances are they determine this growth rate of 5% using their internal models and of course internal kind of information that you probably do not have, right? Then you can just ignore the retention ratio and use the growth rate that they have set, they have commit to set. Because chances are they have insider information, which is why they're able to determine the growth rate, that if you use the retention ratio or the sustainable growth rate, your answer might be quite different. So if they have set a growth rate, use their growth rate. So it's always 1 year before growth. Uh, so I guess when we say 1 year before growth, you are talking about this one, right? At here, this thing here. So yes, it's 1 year before, because the formula is for growing perpetuity is D1, right? So D1 meaning at this level, if you are treating year 3 as now, 1 year from now is year 4. So that's why it is here is your this is your D1, but then at the same time, in the end, you still need to present value it back 3 times like this. So, whenever you face these kind of questions, really encourage you to first of all draw the timeline, right? Because even in your TMA, there was quite a more direct question on this kind of timeline. And if you do not draw a timeline, some of your kind of make the mistake of not knowing where is your now, right? Your now is always 0, and where your values come in year 1, year 2, year 3, right? So as the question gets more and more complicated, it's better to just draw a timeline to visualize. Yes, if year 2 you have 2 times 2 growth. Sorry, do you think I can elaborate what does this mean? Yes, if year 2 you have to times 2 times growth. If it's easier, you can unmute yourself as well to explain. Not too sure what the second question is about. Year 2. Multiply 2 times the growth. Are you trying to say that the what are you trying to say? Are you trying to say that the normal growth at 8% would kickstart in year 3? Sorry, in year 2. No, year 3. Because this question, right? The 8% kickstart in year 3. So you are saying the thing, yes. If it kickstart in year 2, so let's say the question is um the it will fall sharply in, so let's say it grow at high rate for 2 years, right? 2 years instead of 3 years. This is 2 years, meaning that we need to shift everything. So that means we take this one, year one is sorry, year 1 is okay, year 2 is okay, and then for year 3, it is where you have this one, but then you need to sorry, this, so you have 1.8 times 1.2 the power 2 times 1.08, right? So let's say everything pushed back by 1 year, right? I think that's what I'm trying to say, right? Everything pushed back by 1 year. So this is the year, this will be year 3, and we stop at year 3 because at year 3 means that the value here, let's say is, I don't know what is this, maybe say, let's say it's y. If the value is y, okay, if the value is y there, which is this thing here, y, so then our value will be, so this is in year 3 is y, and it means that when we calculate terminal value, we are calculating terminal value as of year 2, and so this is terminal value as of year 2, and then after that you need to discount it 2 years. I hope that's what you're trying to say. I hope trying to ask. All right. Okay. So there is also a generic formula. Okay, so this is the using Excel, which in your GBA, in your ECA, you can use Excel, you can do this, right? But in the long ago, well, not very long ago, but in case those of you are taking your CFA, chances are you don't have Excel, right? You need to use a formula. You need to memorize a formula. And so this is the formula to memorize. And it's not too difficult to understand. Let's try to dissect this formula here, right? So this formula, this part of the formula, can you see that this part gives you the first period of supernatural growth here, right? The summation of all the dividends. Okay, summation of dividends, I want to highlight you is this thing, right? In this thing, the summation, you are summing all the dividends here. Can you see the present value of all the dividends for the first 3 years? So the first part of formula gives you the summation, which is here, the summation. Then the last part of the formula gives you the normal growth at a growing perpetuity. Can you see that this, okay, maybe I'll use this color here. This portion here is your growing perpetuity, and then your this portion here is your discounting of your terminal value. So in light blue is your calculation of terminal value, and then this part here is your discounting. So it's actually the same thing, but now it's displayed in a formula form. In case you don't have Excel, you can use formula like this to help you solve the question. In this case, for two-stage dividend growth model, I'll encourage you to learn this method here, learn this method instead of just using this formula so that you really understand the steps in order to get the answer. All right. So, let's take a short break. As usual, we like to do two breaks. Let's take a short 10 minutes break before we go through this example on the two-stage dividend growth model. All right. Okay, I'll pause here. If you do have any questions, or in case I did not answer your question, feel free to type them in the group chat, and then we'll come back in around 10 minutes. So 8:15. Welcome back. Hope you have a quick short break. Um, how's everyone doing so far? Yes. Okay, good. Okay. Hopefully this one is I think this for lecture 3 is a bit lighter, I would say in that sense. Lecture 4 will be quite a bit heavier again. So so this one really try to use this lecture to understand the basics. Um, and then for lecture 4 will be a bit more again more intense. Right, but good that everyone's doing well. Okay, so let's look at method 2, right? So the method 1 we earlier saw was the using the Excel where we just discount the first 3 years using the present value formula, whether it's in Excel or you can use the formula given by this form. Now, a better way, right, is to actually use this idea of the growing annuity formula. So let's look at what's happening here. Okay, so we have a current dividend that's being paid at $2. Growth rate for the first 3 years, which is the supernatural growth rate, GS, is 15%. Long-term growth is 4%, right? Required rate of return is 10%. Okay, so what can we do here? We know that for the first 3 years, we are going to grow at 15% for 3 years. In this case, recall that in lecture 1, even though we didn't go through the time value of money, or maybe recall in your FIM 203, where we learned this concept of growing annuity. And the idea of growing annuity is that, okay, we have a cash flow that's growing every year, but for a fixed number of years. And in this case, in this example, we are going to grow for 3 years. And so what we can simply do is we plug in the values into our growing annuity formula, taking note that in our growing annuity, C is D1, right? So this current dividend here is D0. So we need to consider D1 here, which is 2 times 1.15, right? So, and then you plug in the rest of the formula. So using the growing annuity formula, I have now determined the present value of the dividends for the first 3 years. Thereafter, we simply determine the value of the dividends in year 4. And once we know the value of dividends in year 4, we can use this value to determine the terminal value in year 4. And after that, this is the terminal value, then we discount it 3 times. Okay, I'm going to draw a timeline just for explanation so that you have a better understanding of what's happening here. 1, 2, 3, 3, 4, 5, right? So we know the first 3 years is calculated using the growing annuity formula here. Now, on the 4th year, we have calculated the dividends to be 3.16, right? On the 4th year here. Okay, so we use the growing perpetuity formula, which gives us the value as of year 3. So I'm just going to use this color here as of year 3, right? And this is where we use this formula here. So this is the terminal value. So terminal value equals to 552.72, right? But the thing is, now we know its terminal value at year 3, meaning that we need to bunny hop 3, how many times back? 1, 2, 3. So we need to hop back 3 times, which is why we present value the terminal value. Okay, so once we have determined the present value of terminal value, we just add which 2 figures? We add figure 1 here with figure 2 here to give you the valuation of this firm. This, of course, is a very fast method, if you notice. And at the same time also, in a situation where you do not have Excel, for example, for those who are interested to do the CFA, this method will be the best method to solve your question. Of course, in your ECA, your GBA, you can use whichever method. It doesn't really makes too much difference. But for those of you who are interested to take your CFA, this method is important because there can be situation where let's say, right, let's say you are growing at you're going to grow at 15%, say 15%, but let's say in your CFA they give you for 15 years. Now, without Excel, it's impossible, right? If you do it manually 15 years, you will not have time for your finish your CFA exam and you're likely going to fail, right? So in this case, you must use your growing annuity formula. Of course, in this case, 3 years. If you know you want, you can just manually calculate. That's fine too. Okay, there's some critiques over your two-stage model, the most simplest form. It assumes that the biggest issue is right. It assumes that the growth rate dropped from a high rate to sustainable growth overnight, right? So less than 1 second, it just drops suddenly. This is not realistic, of course, which is why we use the H model, which we'll talk about in the next slide, where the sustainable growth rate is reached over time. So, of course, in your two-stage model, there is a underlying assumption that dividend payout ratio and the risk remains the same within the two stages. Again, might not be very true. At the same time, sometimes it's difficult to estimate a number of years of high growth. So, having understood some of the downsides, let's see how can we use the H model, right? Where the H model, we will have a gradual decline in the growth. So again, it assumes uh, a high growth and a low growth. There's going to be a decline of the growth from a G plus to G over a certain number of years. And important take note is that the H model is an approximation formula where the value of H, which we'll see the formula in just a bit, is just take the number of years to reach the sustainable growth rate, divide by 2, right? You'll see why is divided by 2. And I'll try to explain to you the concept behind it. You do not need to know the concept, but it's good to know the concept so you can understand the formula and not just memorize the formula, right? Um, Again, it has some of the very strong assumptions where payout ratio remains the same, which is similar to your two-stage simple two-stage model. Again, the approximation works only when H is small. H meaning the period where there's high growth is small, right? That means not for 15 years, maybe just for 2, 3 years, 4 years, 5 years, at high growth as it progresses to low growth. So all this will make sense a bit. So let's try to understand the formula here. Okay. So um there are two parts to the formula. Unfortunately, you have to memorize the formula. But the good thing is that your assessment is just a GPA and ECA, so you don't really need to memorize. You just need to flip your notes to look at formula. But again, in case you're doing the CFA, you need to memorize this formula. And so what does this formula say? Okay, so there's two parts here. One and two, part one and part two. Let's look at part one. So the part one of the formula, right, is simply the area of the rectangle at constant growth. So what does this mean? Part one is here. Let me show you. It's just this rectangle where there's a constant growth of GL. You notice that this is your growing perpetuity formula, where it's growing at GL, right? Does this make sense? So this is your first part of the formula. Two of your formula is basically your triangle here, your triangle. And what's the formula for a triangle? Yeah, half BH, right? Half base times height. So where is the base? So the base, so this is equivalent to half base, let's say the base is H, right? This is the base, right? Times what's the height? GS minus GL. Doesn't this look very similar? This one looks similar to this. Can you see? H. And what is H? H is given by the number of years divided by 2, right? So this is, let's say, 0 to H is, let's say, 5 years, right? 5 years. Can you see that in this formula, 5 years is just 5 divided by 2, GS minus GL, right? Which is exactly what we are getting here. H is this, 5 divided by 2, divided by this, GS minus GL. So we are actually just using the basic estimation by the area of a triangle, area under the graph, area of a triangle. And then why we multiply by D and this one, this is going back to your growing potentiality, right? But the base is that we have a formula here, which is the area under the triangle. And then we have these two other additional components, D naught and the growth factor here. So that's why I like to emphasize this is the area of the triangle of supernatural growth. Your initial first part is your area of rectangle. So again, I highlight this is a case of a approximation, which is why this formula seems quite like easy and intuitive. And the thing is, you can either break them down into 1 and 2, formula 1 and 2, or you can just combine them because the base is R minus GL. And so if you do a combination, you simply get this formula here. So for H model, the fortunate or unfortunate thing is that you must use the formula given here. So there is nothing for you to, kind of like change and do anything. So just use the H formula that's given in this slide to calculate the value of the flow. Questions? Okay, I think we're good. We have an example which will help you understand this a bit more. So the same company, ACME, has earning of 15 million in 2008, 5 million shares outstanding, earning growth at 20% for the past 5 years. So again, I like to draw, I always like to draw this kind of diagram here to kind of help you visualize. Expected to grow at sustainable rate of 8% from 5 years onwards, from 5 years, or grow with a linear decline every year from current 20% to reach 8% in 5 years. Okay, dividend payout ratio is 60%, and will continue to remain constant. Risk-free rate is 4%. Market risk premium, okay, is 7%. So this is not return on markets. Beta is 1.1 again, it's the same. So let's try to estimate this, right? So given that we know the dividend payout, earnings per share, we can first calculate earnings per share, dividends payout, what's the dividends per share basis, right? And then we calculate cost of equity, which is given. Once we have calculated all these things, we know what is the dividends per share. This is the important one, right? Dividends per share, right? Then we can use the H formula. I'm going to use this form here, the H formula here. Just take D naught, right? 1.8 times 1 plus GL. GL is your growth at low rate, 8%, times D naught again. Now, what's your H? Your H is 5 years, right? 5 years divided by 2. Okay, so this is H, 5 years divided by 2. Then you have your GS, growth supernatural minus growth normal, divided by R minus growth normal. Any questions? So you'll see that actually the H model is a bit easier in terms of less calculation because we have just like a estimation more formula for you to estimate the value. Um, and so because of that, it's not too complicated compared to your two-stage, simple two-stage model where you need to just use a either Excel to actually calculate. Okay, some strengths and weaknesses of your even discount model. Some strengths, you know, it's very useful to estimate dividend paying companies. Okay, often used to value broad-based kind of equity indexes. The model is simple and there's some clarity as well. It allows you to understand the relationship between the growth and the value. Uh, it allows you to estimate the expected return given a efficient price, right? So, there's some qualitative kind of understanding. There are some weaknesses as well. Of course, we can't expect, you cannot value a firm that is not paying dividends. It must be a public firm that pays dividends as well. That's the important part. Not applicable for unstable growth if the stock is in the early stage, is growing quite rapidly, is not very stable, then it's not very relevant as well. Um, Calculation is very sensitive to the growth rate. You'll notice that the growth factor plays a big role. Recall that I'm just going to flip back to show you an example here. The example that we did. Can you see this one? The value of the growth. So what's the value of growth? The value of is $90 out of 116. That's a lot just based on growth. So if so everything is based on this thing G, right? So if G changes, your value of growth will change a lot as well. So a lot of emphasis is placed on G. Sometimes estimating G can be very tough. Even using historical G figure might not be correct, right? So it becomes very tough to accurately determine the value of a stock using your dividend growth model. Remember in lecture 2, we mentioned a few more other models, right, that we can use. If there is an issue with G, we do not know how to estimate G. What is the one model that we can use, which is a good substitute for models that require estimation of G? What's another model that we can use? Not really. M is to calculate cost of equity, right? Remember, your G is your growth factor, right? So if a model like your dividend discount, okay, so the question is, your dividend discount model is very sensitive to your growth rate here, right? So in lecture 2, we have covered the introduction of all the qualitative models that we can use. What is one model that we can use that will not depend on your growth factor? Your DCF, discounted cash flow. Discounted cash flow, remember what we talked about in lecture 2? Your FCFE and FCFF both also use growth, right? So what can we use? Relative valuation, you're right. That's right. What's one more thing we can use? No, DDM is DDM is here, right? What we learned today. DDM is this thing, right? We can all use DDM. Precedent transaction preceding no, but that's not really a valuation model, right? Transaction, that's like transaction price. Yeah, you're right. We are guessing everything, but you're right. I see your answer. RI, residual income. Yeah, right. Residual. So relative valuation, and your residual income models do not use your growth rate. Do not use G, right? So you're right. Those two are the models that we can use if we are concerned that growth rate is very hard to estimate for this company. Okay. Just be very careful. I see some comment on WACC, CAPM. So those are not valuation models. Huh? Your WACC is not a valuation model. Your CAPM is not a valuation model. They are just helping you calculate the cost of equity, which is your CAPM, and your cost of capital, which is your WACC. So just be very careful on that. Is used for discount rate. Yeah, right. That's right. WACC and your CAPM is for discount rate. And those are your just cost of capital and cost of equity. Yeah. Remember, we have your cost of debt as well. We talk about the whole how we calculate cost of debt in lecture 2. So do a review that in case you know you are not very familiar or not very clear about that. Okay. So it's not applicable as well. Let's go to the last weakness. It's not applicable when growth rate is higher than the required rate of return. Why? If it's growing so fast, and your growth rate is higher than the required rate of return, remember your growing perpetuity formula, your denominator is R minus G. If G is more than R, you're going to have some issue. So you cannot do that. So in such a case where your G is causing you some issue, please use your relative valuation. Please use residual income. So DDM application, of course, it has to be by a dividend paying company. The company will only pay dividend when it's earning money, right? So if it's a negative earnings, the company will not pay any dividend. So then you can use the dividend discount model. At the same time, the company must have some form of dividend policy as well. It cannot be just random policies, meaning or no policy at all, meaning that the dividend is being paid out either flat every year they're going to pay $1 dividend, right? Every year $1, whether the company is making losses, whether the company is making profit, $1, $1, $1, right? If that's the case, there's no policy for dividends. Last but not least, sometimes it's difficult to estimate free cash flow. Remember your FCFF or FCF. Very bad writing. Let me rewrite this again. FCFE. So in this case, both requires estimation of free cash flow. So if it's very hard to estimate, then it might not be the right but it might be better to use the dividend discount model. So in case you do have some firms that do not pay dividend, but you still want to use the dividend discount model, what you can do, you can use the industry average of the payout ratio, right? You can estimate the amount of future dividends because maybe the firm has not started paying yet. Maybe it's just a startup firm. They are going to pay in the future, and based on industry, these kind of firms, like let's say banking firm or financial institution firm usually pay high dividends, whether it's 20%, 30%, right? Then you use this for the future. If not, if it not pay dividends, we can then use the cash flow models, relative valuation, or residual income models. So in case we are valuing firm with negative or cyclical earnings, what we can do is we can use the average of earnings. So especially, right, firms, if you are going to do a valuation of firms that is affected by seasonality, right? Seasonality. So typical firms that is affected by seasonality are your retail firms, right? If you're going to be affected by seasonality, then we need to do some averaging of your earnings. Maybe we take I think if you take yearly earnings, it's still all right. We shouldn't do monthly figures, right? Sometimes you want to more accurately do monthly or even semi-annual, then maybe you shouldn't use that. You shouldn't do semi-annual kind of forecasting or using semi-annual figures for valuation because then you have seasonality, but if you use yearly figures, that should be fine. Um, Apply average ROE and ROA. That's a good method as well. Okay, this is just a repeat. When is it? We were not going to comment on this. Okay, so we do have one very short application question here, right? So we do have two firms, OXY and HRL. Okay, so for these two firms, we do see the dividend per share, so DPS, dividend per share, here, right? The question, which firm can we use dividend discount model and why? So the question is DDM suitable for OXY or HRL? Okay, someone say HRL. Okay, HRL, stable dividend payout. Okay, that's right. Okay, stable HRL. Okay, yeah. Okay, yeah. Okay, see, yeah, you are right. Or you are right. So we can use HRL. And one of the main thing is this, right? So it's because your dividend payout for OXY, you see there is no policy, like no constant policy. See, can you see that when they are making losses, it's still paying out $1. $1, $1. It's stable all the way, right? It's just flat. But your HRL is follows a constant payout ratio of around 30%. Maybe there's some outlier of 50% here, but more or less it's around 30%. Yeah, that's right. So HIL is correct. Okay. Okay. So let's take a quick break, maybe an 8 minutes break. And then okay, so before we go break, so now we're done with today's lecture. So today's lecture is a bit lighter. We're done with today's lecture. And so there are two things that I would like to do before we end lesson. Most likely we'll end slightly earlier. But the first is I'd like to go through two self-review examples here to kind of explain and try to show you how we use the dividend discount model. Okay, so we'll go through two examples. And then after that, we'll touch on the TMA as well. We'll go through some important key points because these key points will be important for your GBA as well as your ECA. And as you probably saw the notification that for the TMA, unfortunately, it being a class test now, they call it a summative assessment, meaning that you cannot return the scripts, unlike your TMA in the past, where it's more like a take-home assignment, and then you get comments, you get feedback on where you make a mistake, right? So unfortunately, we can't return it. It's almost like a final exam kind of maths assessment. But I would like to highlight some important key concepts. At the same time, if you do have any questions relating to TMA, we can also answer that. Okay, so let's just now take a short break. We'll just come back in around 8 to 10 minutes time, right? Then we'll do the last two parts, and then we'll likely call it a day a little earlier. All right, welcome back. Um, Before we go to the last two parts, any question regarding today's lecture? No? Okay, very good. Okay. All right, so there's no questions. Regarding our TMA, any concerns or any question that you had while doing the TMA? Yes. No? Need more time? Okay. Yeah, so I think this is the second term that the school has started doing the class test format for the TMA. So the first term when they did it, there was quite a lot of feedback in terms of the difficulty, the lack of time. So actually the school did adjust accordingly. So of course, even though it is the second time only, we also still want to see where any feedback, and then of course, unfortunately, it will not benefit you, but you will benefit your juniors, in their class test. Because overall, it's still quite a new concept for SUSS to have like a class test instead of a take-home TMA. As you probably know, right? Yeah, most of you are year three, so you have experienced the more take-home assignment for TMA the last 2 years. Why some need go back to school? Yeah, so depending on the course coordinator, some prefer it to be pen and paper. So those usually go back to school. But for those that don't mind doing it online, you can do it online as well. I don't remember the question. Uh, okay, so while your this module you will not have any more class tests because even your ECA and your GBA are both take-home assignments. Maybe it might benefit you for your other modules, but generally I want to highlight that I do notice some very good way of presenting your answers because it's so I'm referring to online kind of like your assessment. So some good way to reply answers is I notice some of your copy and paste um, the answers from Excel to your answer script in the portal. So that will work. So those who did that and of course get the right answer, you easily get the full marks. Um, the only thing you take note is that sometimes Excel, you still need to show the workings. And if you're using cell referencing, you need to be very careful when you're doing cell referencing. Okay, yeah, so that is for presentation. I noticed some of you also type out the workings. Like for example, you say, let me just write it here. Like let's just say 473 minus 315 equals to 160, something like that, right? Then you do like 1.6 divided by blah blah blah, whatever, right? So you really click out the mathematical thing, which is okay, which is good as well to show the answer. And of course, if you have a mistake somewhere along the line, you get method marks. But I also noticed that some of you all ran out of time because you did this, right? So a way to save time is a smart way is to use Excel, right? Maybe a bit faster, and then you just copy and paste Excel. I do see the comment that you will prefer to receive back the answers. Okay. Unfortunately, for this time, we cannot, but I'll give this feedback to the school so that in the next term, in case you're taking more modules, maybe for the class test, they'll release the answer. They allow us to release the answer so that you can learn. Yeah. So I show the formula to calculate and then you copy and paste the Excel table. So that's usually fine. You will, if your answers are all correct, generally you get the full marks. Or if your answers are wrong, but you copy and paste Excel, but you use the show the formula, in case you have some mistake, generally you get some method marks also, right? So using Excel copy and paste will really save you a lot of time. um, rather than typing out all your answers like this. So the thing is, that's why some module prefer for the TMA or the class test to be in school and physical, because generally it's faster to use a pen and paper to write, right? To write these kind of things, it's very fast to write rather than typing it out, it's very slow. So that's why some modules you notice that they still insist on you going back to school on Saturday to take your class test. So that's one of the reasons. Yeah, I agree. It'll be good that Excel can show the number instead of the cell reference. Yeah, I prefer assignment. Okay, so I know if you prefer assignment, I guess for this module, the good thing is that you have two assignments. I mean, take-home assignments, right? Your final exam, which is a take-home assignment, that one, of course, is 50% of mark, a lot of very high weightage. So you can really focus on that. And do very well for your final exam. At the same time, for GPA, I encourage you to also reach out to your group mates now to first of all establish contact with them, and then start reading the questions, see what you can do, or divide the work, etc. Right? Even though we have not really covered all the content yet. Okay. Okay, so besides the comment I made about how you present answer, one thing I would like to highlight as well is on the FCFE and FCFF. Let me just see whether I have the last lecture two. So this why I wanted to highlight this is because even in your in the next lecture, we'll cover in more detail, but I want to highlight this here. Okay, so your FTFE, right? So FTFE and FCFF is here. Okay, so I want you to be very careful that um for your net borrowings, okay, this one is just be very careful. Even though you might not really have any more of these kind of questions, but just for own knowledge, whenever you see net borrowings is given by this, meaning that if there any movement in terms of uh increase in borrowings or decrease in borrowings, right? So if you are not if the question did not give you any decrease or increase in borrowings, okay, change in borrowings, then we should consider using the debt ratio instead. So whenever a question gives you total debt, total asset, right? But they do not give you change in debt, then we should use this debt ratio. So just be very careful when you read questions, whether it's in this module or maybe other modules eventually, where you do need to use this concept of FCFE, just be very careful what the question is giving you. Are they giving you net borrowings, which is change in borrowings, or are they giving you total debt? And in which case, then maybe you should use the debt ratio. Okay, that's a good question. What's the difference between DCF by FCFE and FCFF? So we did cover this in case you've forgotten about it. We did cover it in quite detail in lecture 2. Don't worry if you forget, because in lecture 4, the next lecture, we are going to repeat again, but in more detail. However, if you are too confused, I encourage you to rewatch lecture 2. But let's just do a quick recap, right? What's the difference between FCFF and FCFE? So FCFE is the free cash flow to equity holders. So there's this very good slide. Let me just flip here. This is the good slide here. FCFE, FCFF, FCFE. So for FCFE, you're taking the perspective of equity holder, right? So it's the cash flow to equity holder. Now, for FCFF, you are taking the perspective of both the equity holder and debt holder, meaning that you are taking the perspective of the capital provider. Capital provider means capital from debt and capital from asset. All right. And how does this make a difference? So there is a slide in lecture 2 that is very good in terms of explaining this. This slide is very important. So if you forget, so these two slides here, if you forget, I encourage you to re-watch lecture 2 and just focus on slide 42 and 43. And the idea is that, so the layman term, right? Um, to just understand the concept is this. FCFF, we are trying to see what is the cash flow to the debt holder, and because debt equity holder, I mean, and because of that, we are looking at both perspectives. We do not want to consider anything relating to debt inside our cash flow, which is this thing here. Okay. And maybe you ask, why do we want to consider FCFF? That's because, you know, maybe there is a change in leverage for the firm. So we want to look at it from a firm perspective, right? The cash flow for the firm. Because a change in leverage, you want to make sure that you do not consider the leverage component, which is largely the interest payments, into your cash flow. Now, on the FCFE, the layman term is that you're just looking at an equity perspective, equity holder, meaning that shareholder perspective. For a shareholder perspective, you need to consider interest, the deduction of interest from your cash flow, right? Because you have to remove this already before you can consider what is the cash flow left for equity holders, right? And so because of this, that's why there are some explanations here, which we have went through in a bit of detail in lecture 2. The equity, I wouldn't say it's exactly the same because the discount rate is different, right? For FCFF, which one should we use? For FCFF, yeah, WACC, FCFE, use the, yeah, OCE. Yes, that's right. So it's different. And conceptually, it's also different, right? First of all, FCFF, you are valuing the entire firm, right? You're valuing the entire firm. FCFE, you're only valuing the equity portion of the firm. There is a small little comment here, which I think I highlighted as well in lecture 2. Can you see this? Value of equity equals value of firm minus value of debt. This is important, meaning what? Your FCF, your value of firm or your equity, let me just write here, equity E plus D equals to value of firm, right? So E plus D. So you just shift this one here. Okay. So there's a difference. Okay. So this is the part that I want to just bring your attention to in terms of FCFE. Uh, which one? This one, this part here. Just take note, what do they give you? Are they giving you change in borrowings or total debt? Any questions on this? Yeah, thanks for the question on the FCFE and FCFF. That's right. I think overall, besides this part here, which I like to highlight, again, we'll go into a lot of detail of FCFE and FCFF in the next lecture. But overall, I think the class did very well for your TMA. In case you realize that you are lagging behind or you're not very familiar and you not really score too well, do not hesitate to reach out to me. As some of you all know, those that have dropped me an email generally reply email quite fast. So if you do have any questions, really happy to see how can help you answer some of your doubts over email as well. All right. So I guess the TMA Besides that, not many. Any other questions before we move on to the examples? Oh, yeah, yeah, there's a question. Sorry, I saw a question regarding the GBA. It has to be Singapore listed, so it has to be at SGX. In terms of selecting the stock, just want to highlight that try to select a stock that is a bit easier, right? Don't select, say, so avoid selecting stocks that are like large conglomerates, real estate firms, like let's say REITs, Keppel, Keppel is so big, there's so many things. It if you are confident, of course, I encourage you to challenge yourself. But those large companies like this, because there's so many segments, right? It's very complex. For example, how do you estimate the beta, right? It's very complex to estimate the beta for Keppel, where there's so many things. They have Keppel real estate, they have Keppel asset management. They're all very different operations, and so it's very hard to estimate and very hard to value, which is very high level. So try to do something that is simple, that has one segment of business, and it's easy for you to value the firm. Yeah, so things like startup is very complex. So I encourage you to select. Okay, so one of the best ways to select companies is to select companies that um you know does not it's not very popular, it's not a fancy name. So in one example, right, um again I want to highlight the importance. So I'm just going to the our tutorial group. So if you notice, there is this Spindex case. So Spindex is actually a company listed on SGX as well. Unfortunately, you can't use that company because I already gave you like a almost like a model answer kind of thing. Not really. Yeah, I'm pretty sure you can do much better than that. But this is a very good write-up in terms of some analyses that can be done. So like choose a company like Spindex, which it's not very common, but it's a very simple model. They just do manufacturing and that's about it, right? It's like it's very boring, but it's simple. It helps you choose which the competitor, etc. Okay, I do see a question. The three competitor needs to be in SG. Generally, depends on your company. Um, for example, if you choose SIA, okay, your competitor cannot be in SG, right? SG, Singapore only has SIA, right? So maybe you need to choose something like something else that is in the region, for example, Malaysian Airline or something like that, right? So there is no fixed rule whether the competitors needs to be in SG. Which company do you waste your time? Bus 490 or Starhub? Well, yeah, Starhub is quite weak growth. Competition is a bit too stiff, and you notice that there are a lot of small players in the market now. Things like previously, I think it was quite good because there was only three key players, right? Singtel, Starhub, and M1. But now there's so many small players that the company is, of course, not doing too well. But I think, if I'm not wrong, Starhub does not has presence in other markets as well. Correct me if I'm wrong. I think I remember I did analysis quite a while back. They might have some operations overseas. So maybe those are better. So again, so what I'm trying to say is look at the Spindex case as well as the Nike case. Nike case, not in Singapore, but then this will clarify a lot of the common misconceptions in terms of how you pick figures, right? Because now in your GBA, right, the basically the world is your oyster. You can pick any figures wherever you can find. So the thing is, you have a lot of choices to make. How are you going to calculate the WACC? How are you going to find cost of equity? How are you going to find cost of debt? So you see, it's like, oh, how do you determine your interest expense? So look at the Nike case. It's using the FatSet platform. previously you all have that set, but now they change it. Of course, S&P Capital IQ and Refinitiv is quite similar. But this case really explained to you, okay, why am I selecting this? Why am I selecting certain numbers? Um, Especially when you have so many information that is found not only in the annual report, but also in your market intelligence tools. They even talk about income taxes, income tax, say cost of equity. How do you determine cost of equity? Okay, really good. I encourage you to look at this as well. I'm not sure I can highlight here. This one, this is very good. This is to determine your equity risk premium, right? So look at this. This is also very important. Yeah. Okay. Calculating WACC, uh, working out the numbers, dilution, once you look at real case, there are a lot of things to consider about stock dilution, etc. So please look through the case. It will really, these two cases, it will really help you in your write-up. Okay, so any questions, other questions regarding your GBA before the last part? I do see. So yeah, choose your companies and yeah, try to start a bit early. Okay, I guess no questions. Okay, let's look at the first. I want to go through question one. So let's look at question one. Um, so Coke believes the terminal value that she has calculated earlier for guys may be an error to determine that the dividend payout ratio in year five is 60%, and that the stock should sell at a trailing PE. So this one is a bit of the last lecture, but don't worry, it's just the PE ratio of 13. Just think of it as the PE ratio based on the current earnings of 13. Okay. Uh, there's some more information. It currently pays $1 of dividend, D naught. Okay. Cook estimates that this firm will grow at 20% for the next 5 years. The growth rate will fall to 5% in the sixth year and remain at this level thereafter. Given its weaknesses, Cook is uncomfortable using the CAPM estimate to estimate the cost of equity. Instead, they use the bond yield plus risk premium approach and found that the long-term debt trading at 8.2% due to maturity. We believe that the risk premium is 4.5%. Calculate the value of the share. Okay, so this one, the interesting thing is this, right? There is a trailing PE here. So the interesting thing is that there is a trailing PE, okay, which we have to use as our terminal value in a bit. Okay. So first determine the cost of equity. So cost of equity quite direct. We know our yield to maturity, just add our equity risk premium. So you get 12.7. So then thereafter, we want to determine our various dividends that's being paid out in year one, year two, year three. And so we know that at the start, D naught is $1. So we can determine the various dividend that's being paid out year one, year two, year three, year four. And let me just confirm again how many years are they going to pay. You will grow at 20% for 5 years, right? And after that, you'll fall to 5%. So for the first 5 years, it's going to grow at 20% here. This one I think is quite all right. Not too complicated. And then we can also do the discounting using the cost of equity that we've determined here. Now, the interesting thing is how do we determine the terminal value using the trailing PE, right? So let's try to understand what's PE. So PE, um, price divided by earnings, right, is 13. Okay, price times earnings is 13. So we know that if we know the earnings times 13 will give you the price of the, so how do you get price? So price of the share equals to 13 times earnings or earnings per share, right? Either earnings or earnings per share is fine. Okay, so now the thing is, we can find the earnings per share by knowing, since we have the dividends here, right? And what are we given? We are given that the dividend payout is 60%. So yes, so okay, you are very fast. So PE equals to dividends divided, yeah, okay. But let's take it a bit slower. So the earnings per share, so earnings per share, EPS equals to what's your dividends that you have, or maybe a better way to put it is actually what's written there already, but let me just rewrite again. Better way to do it is your EPS times your payout equals your dividends, right? So your EPS divided by your dividends equals to dividends divided by payout, and your payout ratio is 60%. So what's your dividends? Your dividends is 2.488 divided by 60%. So this will give you your earnings per share of this figure. And we know that if we are determining the price, which is at the end of the terminal value price, we just take the $4 and 14 14 cents, or $4 and 14 cents multiplied by 13, which is here, to give you your price and your terminal value. But this price is at your terminal value of this, right? Here, 5. So we do need to discount this back. You get 29, and then we add 29 plus this, right? To get 35.7. So the interesting thing about this question, why I want to highlight, is this trailing PE, and we use the trailing PE to determine the terminal value. Do you have any questions for this? So for the formula for trailing PE is generally the price is the current earnings and the price. Yeah, current price and the earnings they have. Current earnings. Yeah. So the trading P and all this, we will go into a lot of details in the last lecture. So we'll go how we calculate trading PE and then the figures to pick. So yeah, it's a bit on the last lecture, but I just wanted to highlight this. Okay, there is one more question that I just want to highlight that I thought was interesting. So anyway, encourage you to go through the questions just to give it a try. Um, Now, okay, this one. So this one is our two-stage H model. So we have this portfolio manager. Um, is researching on this firm called Vinci SA. So Vinci is the largest construction company. It operates in France, approximately two-thirds of revenue, and the rest of Europe, one quarter of its revenue. They pay regular cash dividends. Okay, regular cash dividends. Since then, it has paid two dividends per fiscal year, interim in December and final in May. Although the past 5 years, the annual dividend grows 26% per year. Okay, we know a growth of 26%. Having decided to compute the H model estimate for DG, gathered the following facts and forecasts. Okay, we do have a stock price of 57 euro. Current dividend paid, current which is D naught. Okay, D naught is 1.37. The initial dividend growth is 24%. It will decline linearly during a 12 years period to 6%. So I would always like to draw this graph like this. So we know that it's going to start at 24%. It's going to decline linearly 12 years to 6%. Estimated return on equity is 10%. Use the H model to estimate the per share value. Okay, so once we have all these figures, we use the H model, which is actually quite simple, right? Because the H model, we have just a formula and it's throw all the numbers in the formula, we can get answer straight away. So this is using the part, part one and part two of the H formula, not the combined version. Both is fine. We can calculate the part one and part two using H formula. So this one I'm not so interested. But what I'm interested in is what does this mean, right? What is part one? What is part two? Which I think this question, uh, the solution provided gives a good explanation, right? Okay, so recall that for part one, this is your when I explain to you what's this, what's part one? Your triangle or your rectangle? Rectangle. You're right. So rectangle. Your part two is your so your part two will be triangle. That's right. So we know part one is your rectangle, which is your base, and then your part two is your decline, right? Okay, so having understood that, okay, let's look at part two of the question. Estimate the value of DG share if its normal growth period begins immediately. So normal growth period begin immediately. So what does this mean? It means that this thing, you're interested in the rectangle here, right? It begins immediately. So there is no decline in the growth rate. And because there's no decline, we just interested in the rectangle. So rectangle is this. So the solution in part two that explains. So if DG experience normal growth starting now, the estimated value would be the first component, which is the rectangle, like what we mentioned, the rectangle of the H model, which is 36.31. So the note that the extraordinary growth adds 36.99 to its value, resulting in this. So this hope this explanation shows you that the rectangle is your normal growth, right? Which is this part here given by this color portion. Okay, so part three, evaluate DG share, evaluate whether DG shares appears to be fairly valued or overvalued or undervalued. So we know that the share is trading at 57 euros. And we calculated the intrinsic value is 73 euros. It means that the share is undervalued in this case because intrinsically it's supposed to worth 73, but then now they're only trading at 57, so it's lesser. So you should buy this undervalued share. Okay. All right. So actually, those are the two questions I thought was interesting to go through. Really encourage you to go through the other solutions, questions with solutions. And then if you do have any questions, you can reach out to me in terms of your as you practice the questions. Um, any other questions so far? All right, I guess there's no questions. So today we'll just end a little earlier, and then we'll pick off on lecture three. Okay, do you mind going through question? Okay, let's go through question three. I guess you're referring to this one, is it? Question three? Okay, so let's have a look at question three. Is an analyst from a equity mutual fund that invests in a British stocks at the beginning of 2008. Owen is examining a domestic stock or possible inclusion in a fund. Okay. One of the stocks that he's analyzing is this company, BSY. The stock has paid dividends per share of 9, 12.2, and this at the end of these 3 years. The consensus forecast or analysis is that stock will pay dividends per share of this at the end of 2028. Okay, and this on 2029. Required rate of return is 11%. Okay. Com Compare the compounded annual growth rate of dividends from 2020 2005 to 2007, inclusive, beginning from this to 15 per day with the compound annual growth rate from this to this. Okay, so we have, let me see. Okay, let's pull out our Excel. Okay, I'll share my screen for Excel so we can have a look. You can try to do this with me uh, so that you can practice as well. Okay, before that, any particular questions regarding this, why you would like to go through question three? Is there any particular query that you have? Or is it in A or B or actually nothing particular? Okay, so let's just see. You have 9, yeah, 12.2, 15.5. Okay. So what's the role? Let's see. Right. So far, so good. Let me just format this. So we found the growth to be this. Um, let's see. So the the first one, you can just take this. See what's that. Compare the compounded annual growth from this the consensus predicted growth for this. I'm thinking this one is no, shouldn't use this method. Give me a moment. You can try this with me as well. Let's have a look at this question a while. So let me just use let me just give me the divided. Oh, okay. Uh, yes. So let me try this. Yeah. Yeah. I realized that maybe I should do this uh CAGR. Yeah, let me see. 3 years. One. Mm, you got pay one. Let me see. And then, this one, this one. Yeah, I got 19.8 as well. Let me see. Yes. Okay. So you're right. Okay. So we should use. Okay. So we shouldn't use this. We should use the CAGR. Let me just put this. Okay, it's 15.5. The ending divided by 9. All right. Power of 1 divided by 2 minus 1. Should be this. Okay, everyone get that? Okay. So this is our CAGR. Let's wait. what's- Okay. Yeah, we need to put the bracket. Is there no other method? Mm, this one I have to think about it, whether there's a better way to do it, not using this CAGR formula. And you, because when I was doing this, I was thinking to use so after doing this, so I got to try, but I'm thinking to use compound 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 average. Uh, let's see. Geometric, yeah, correct. Sorry, geometric return. So that's what I was trying to do. So if we do geometric, I don't know whether it will work, but that was the initial. Let's just try out. So let's just try 1 plus this. Oh, it works. It works too. Yeah. So initially, I was doing this because I was thinking to do the geometric return. I guess you can use the CAGR or you can use this geometric. Yeah. Okay. So let's look at part part two. Owen believed that BSY has matured such that the dividend growth will be constant going forward at half the consensus compounded annual growth rate from 2027 to 2009 inclusive. 27 to 28, so both inclusive. So these three are okay. Using the growth rate forecast for Owen that has a constant from. Okay, so now we're using these three. Maybe we use geometric. Let's try to use the geometric one. Let's do this, right? One plus this times one plus. Okay, 8%, and they say it's half, right? Correct, 9%. So growth is where at 9%. The return on equity is 11. Uh, let's see, what's that? Estimate the value of the stock as of the end of 2007. Okay, 2007, that means is this. So this is the 15. So divided by our return on equity, right? But this is on 27. So they say we need one, two, if I do it correctly, divided by half, half the annual estate inclusive using the Yes. Mm. Let's see. Yeah, let's try to do this together. Okay, let's see. Have nine. So I should use 18.66. Okay, seems like it's all. Yeah, but I'm using CAGR as well. I'm getting 9%. To use this. Yeah, but the answer is still of 475, 425. Yeah, just like your Hmm. Answer question wrong. Um, okay, you know what? Let me get back to you on this. Let me try this question and see whether is the answer really wrong. Okay. You know what? I think it's getting a bit late. I think some of us are also dropping off. Okay, let me get back to you on this question. Whether is it the next lecture, uh, and hopefully we can figure out the part B. It's okay. It's good to give it a try. Um, yeah. Okay. Yeah. I know it's also a bit late. All right. Have a good rest. And yeah, let me get back to you on this. Thanks for asking the question. Let me just stop sharing this. Actually, have I stopped recording? Stop recording.